the RBA is expected to keep the cash rate on hold when it meets today, but it is far from over for homeowners. Michele Bullock chairs her first meeting as governor today. Mortgage holders aren't in the clear just yet, though. Let's bring in Shane Oliver now, the Chief Economist at AMP. Shane, thanks so much for your time, as always. So is that about right? Hold today, maybe not for Melbourne Cup Day?
That's right. Look, our base case is that we're at the top, that we're not going to see further rate hikes from here, and the next move will be a cut, probably around June next year. But that risk of another hike is quite high. I don't see them moving today. I think since the last meeting, we've seen further signs that the labour market is cooling, with now 5 quarters in a row of falling job vacancies. We've seen ongoing weakness in retail sales. If you strip out the impact of higher petrol prices, the trend in inflation is still down. So all of those things, I think, will keep the RBA on hold today. But there's probably something like a 40% chance we might get a hike on either Melbourne Cup Day or in early December, because there are signs that wages growth is accelerating. And that is obviously something the Reserve Bank will be quite concerned about. And that is obviously something to watch out for. But I think Michele Bullock would rather wait for the September quarter inflation numbers out at the end of this month and the next round of RBA forecast reviews, which will be in early November, before she does move.
Okay, so why is that? Is the August inflation number, it was a monthly read, is that just seen as perhaps a blip, a spike on the radar, and it could moderate again, or is that too hopeful?
Well, that's my view. We know that petrol prices rose strongly in August. They're up 9%, or fuel prices generally up 9%, probably a bit more coming through this in September. So that's going to, obviously, it has a direct impact in pushing up inflation and also an indirect impact on transport costs. But the flip side is that 18 months ago, when petrol prices were surging, quarter after quarter, in fact, it went on for a long time, people were still happy. They didn't like it, but people were still happy to get out and spend, because we've just been released from the lockdowns. People had a lot of pent-up savings. Now the situation is radically different. People have seen the cost of living pressures, the interest rate hikes eat into their savings, into their spending power. And so therefore the environment this time around is a lot weaker. And so I think that the rise in petrol prices is more going to act as a tax on spending in other parts of the economy. Even though it adds directly to inflation, I think elsewhere people will have, on my estimates, $11 a week less to spend elsewhere in the economy, which will act as a drag. So therefore, I think the Reserve Bank can safely look through that, even though it's obviously still a risk.
Oh, that's a really good point. Yeah, it's essentially a tax on spending anyway. But what about, I mean, people are still holding on to their jobs, aren't they? We're not seeing, the unemployment rate tick up in any dramatic way. What's happening there?
Well, there's a bunch of things happening. We've still got a fairly tight labour market. Businesses still complain about labour shortages, although those pressures are easing. And you can see that in the vacancy numbers. They've been falling for 5 quarters in a row. But you're right. The strength in the labour market has protected people to some degree. Yes, they've got to pay more to service their mortgage, but as long as they still have a job, that's fine. But history also tells us that there's a lagged impact there, that if you go back to the late 1980s, when interest rates were increased dramatically between 1988 and 1989, the jobs market continued to improve right through that period. It was only in 1990 that it started to fall apart. So the impact of higher interest rates often occurs with a long lag, and I think it will be the same this time around. That as we go through to the end of this year and into next year, we are going to see higher unemployment. The other thing to note is that we need to generate something like 30,000, 35,000 jobs a month, because we've got these record population growth numbers coming through, mainly on the back of higher immigration levels. And therefore, you can still have jobs growth, but I suspect that jobs growth will slow below that critical level, and consequently unemployment will rise, simply because you've just got more people competing for jobs as population growth remains so strong. So that's going to act as a bit of a drag. But so far we haven't seen that, you're right. But I think as we go through into next year, we will see higher unemployment, and that will start to cause more pain.
Okay, that said, given everything you've just said in the last couple of moments, it seems that it's certainly not a fait accompli that the RBA will even raise rates in November. That would be a pretty line ball call still, wouldn't it?
Look, it is a line ball call. There was a recent survey I saw on the weekend, or yesterday, in fact, in the Financial Review, which seemed out of 42 economists, I think half expected no change for the rest of this year and half expected a rate hike or two. The consensus of that group was one hike, but there was a couple in there with two further hikes. So it's a bit line ball, as you say. But I think the risk is a little bit less than that. I wouldn't say 50% chance of another hike. I'd say 40% chance of another hike. And from my perspective, that risk of recession that I've been worried about for the last several months now, if you go back to May, I thought the risk of recession had gone up to 50%. That risk is still there, still very high. It takes a while for these things to fully show up. And the difference now compared to 6 months ago, 12 months ago, is that monetary policy is already very, very tight. So Michele Bullock takes over at a time when all the heavy lifting has been done by Philip Lowe. We're not talking about easy monetary policy anymore. We're talking about very tight monetary policy. And that's continuing to bear down. So on the one hand, you can say, well, there are these signs of strengthening wages growth in enterprise bargaining agreements and elsewhere. That could be a case for another hike, which we put the risk at 40%. By the same token, we also know that monetary policy is very tight and there's increasing signs that is really starting to slow the economy down.
Shane Oliver, always good to see you. Thanks so much.